From the news capital of the world, you've landed on the Daily Objective from the Ayn Rand Center, UK. We are so delighted you are with us from wherever on the globe you are. I mean, I'm in sunny Chicago, Illinois. Our guest today, Seth Levine, is in New York City. You might be in UK, you might be in South America, the Middle East. We are students of objectivism from all over the globe. And that's why we're glad you're here, because we're here Monday through Friday studying objectivism. We're all students of this fantastic philosophy inspired by Ayn Rand. And that's why we present this daily show, bringing you, I don't know, some small-time experts like Harry Binswanger. Often Dr. Leonard Peikoff's been on this channel, people like James Valiant and so many others, including our guest today, Seth Levine. So happy to have you with us today, Seth.
Thanks for having me. Always a pleasure.
Well, Seth is a financial expert. He, of course, is the proprietor over at the Integrating Investor website. We're going to be talking a little bit about what's happening in the financial world and his expertise, in particular banks. You kind of haven't been following the markets. A lot of them have been failing as of late. But first, I want to thank our brand new member, our online member, Joni. She has become a YouTube member. We appreciate that because it's thanks to people like Joni that we're able to bring you these programs day after day after day. So take this opportunity, hit us up on the super chat, let us know that you value the programming, and let us bring it to you every day of the week. So here's Seth's article, The Differences Between Today and the GFC, the Global Financial Crisis. You younger people might not remember that, but we're talking about what, Seth, 2007, 2008.
Correct. Yeah, that was, pretty harrowing days for those who can remember. We've
had some harrowing ones here. I mean, you right off the top that this has already been the second worst year for bank failures. You wouldn't know it given the fact that the markets have been soaring, but bring us up to speed on just exactly what you've written about in terms of the similarities, maybe some of the differences between now and what happened 15 years ago.
Yeah, absolutely. And, before we start, we should definitely wish everyone a happy unofficial start to the summer. This is, Memorial Day weekend for us in the States, and it kind of kicks off the summer season. So not a bad way to start. So, so as many people probably know, there have been, banks are back in the news again. There have been, 4 or 5, I guess, at this point, notable bank failures this year, and like really sizable. So whenever you hear, banks failing, from a market's perspective, people automatically try and draw the comparison between today and the great financial crisis, because that was such an awful time in history from a wealth creation perspective, from a markets perspective, and just from a existential perspective for a lot of people. So naturally, my mind kind of went there, and I think we have a chart here just to put how bad the banking crisis is. Because again, if you look at kind of the equity markets, or, you wouldn't necessarily think things are too bad, but when you look at kind of what, the size of the bank failures, it's quite staggering. So, if you could throw that slide up, right there for us. Daniel, can you make it the main screen, or is it up?
I think we see it. So on the left-hand side is a couple of big circles and a lot of little tiny circles reaching up. That was the great financial crisis in 2008. And on the right side, present day, you've got 3 huge circles that are basically just the 3 big banks, almost the same size in terms of assets.
Yeah. And, so what this is a chart of, it's basically each dot represents a bank. The scale on the bottom is the time frame, so the years. And each bank that fails is a scaled circle of the amount of assets that they have. So as you can see, during the the great financial crisis, this pretty big circle in the middle. I think that's Washington Mutual, and then you have a lot of these other smaller banks that failed, and you add them all up, it's a pretty big number of banks that failed from an asset perspective. Today, you look at the right. Huge spike up, but it's really just been by a couple of banks. And again, large banks, certainly not the same size as, the global banks like JP Morgan and Bank of America and names like that, but very large banks nonetheless. And in fact, bigger than or close to the same size as Washington Mutual from 2008. And this doesn't even include like Credit Suisse, which was taken over by UBS, but call it a failure. So, long story short is, banking crisis and market crises go basically hand in glove, as I put it. And there's an important reason that they go hand in glove that seems to be lost upon a lot of people. And it's mainly because when you think about what the financial system is, what investment markets are, like markets are a marketplace, but for the most part, most of the transactions going through in the financial system is being conducted by financial institutions. That's why it's a financial system. So it's no surprise that when we see trouble in banks, we see trouble in markets, because the markets are just reflecting what's going on with banks. So that's kind of where we are today in terms of, we've seen a lot of big bank failures. So we've seen sort of indication of bad stuff happening in the real economy, so to speak. And naturally, investors are wondering, are we going to see this reflected in the financial markets? So that's kind of like where we stand today.
Well, I have to ask Seth, just in the last couple of months, the articles written about the recent big bank failures basically cite two things as the cause. One is lack of regulation, and the other, and this is even from those on the so-called right, and greed. Is CEO greed, investor greed, Wall Street greed. That's what, and of course, that's what people said about the great financial crisis 15 years ago. Same thing,
of course,
not enough regulation. So this is, deja vu all over again. But, from your perspective, you're talking about factors in the article that have nothing to do with so-called greed or lack of financial regulation at all.
Correct. Yeah. And it's pretty interesting because, a lot of the similarities that I see in the markets are, or done in popular press seem very superficial to me. And again, it's kind of drawing the analogy between kind of market consternation and bank failures. But again, those should come together. So that's not the similarity. That's not, if there is a similarity, that can't be it. Is the way how I see it. And if you look at what happened in 2008 and you look at what happened now, they on the surface were very different. And in fact, you hear a lot of analysts talk about how different they are. The great financial, what happened, let's start with today because it's easier to understand. So the banking run today, people characterize as idiosyncratic, meaning very individualized to each individual bank. Nothing broad and nothing broad that would apply to many banks. Basically, what you had were traditional bank runs where you had a bunch of depositors looking to withdraw their money, and the banks didn't have enough cash on hand to meet their depositors. So essentially, they become insolvent and they file for bank some sort of protection without getting into the details. That's what happened today. People, part of that was driven by maybe the speed at which communications can act today. So for example, I think Silicon Valley Bank and Signature Bank, which were two of the larger ones, they saw like single day deposit outflows of like 20%, which is just an unprecedented number. And if you go into the article, there's a chart there put up by the Fed where those numbers are just bigger than anything ever seen before. And yeah, there's the article and a chart in there, and you could go to the article and kind of dig in a little bit more. But basically, the bars under Silicon Valley Signature are much bigger than what you see in either 2008 on the left or on the right, which was content in 1984. Where those were the next two biggest bank runs. This is just huge today. So that's today. In 2008, what happened? This was a financial crisis. It's still pretty misunderstood in my view, but it is more understood now than it had been, particularly around at the at the time that it happened. But what happened is you basically had this was a institutional kind of run on the bank. Basically, the way how financial institutions work among each other is they don't necessarily borrow from each other directly. What they do is they have what's called collateralized lending schemes, various ones. They basically take a bond, they pledge it to another one, and they borrow against the bond. So there is collateral in there. It's not an unsecured loan, meaning it's just a gentleman's agreement, for lack of a better word. But there's something there that's underlying, and there are various rules about how much money you can borrow against it. So in 2008, what happened is these bonds, many of them were backed by subprime. So when losses from subprime housing started to percolate in these bonds, they didn't actually hit the bonds themselves. They hit kind of related bonds. And the rating agencies realized that their models were wrong, and they started to downgrade these bonds because these bonds were very high quality. They were AAA rated. So as they were getting downgraded, that basically screwed up the entire borrowing schemes. I explain it more in the article. And what happened was these banks found themselves short on money, just like the banks today were kind of short on money, and they had a collapse too. So it seems like very different. One was like kind of housing, rating agency, markets created all the failures, and today is, you know, traditional bank runs aided by technology.
But isn't there similarities, Seth? And thanks. It's a really interesting and important understanding of the differences, more importantly, and driven by your expertise. But isn't there a common thread that government, in many ways, is at the center of both? I mean, from what my understanding is of the recent bank failures, is that the government flooded the system with cash, and that these banks had deposits, and they bought, the safest asset they could find, U.S. Treasuries. Now, the value of those Treasuries have fallen dramatically as interest rates have risen dramatically. So it's not as if they made bad, risky loans, but government incentivized them. Just like in 2008, government incentivized banks to make all the, what do they call them? Not liar loans, but to subprime, as you said, people to, right. So government in both cases was at the center of these so-called market crises.
That's exactly right. So basically, in both cases, that is the thread. In both cases, there were, you have financial crises because you have basically correlation of banking failure, or you have many banks failing at the same time for the same reason. And that is caused, in my view, by the centralizing force of regulation and laws. So today what we saw is, because we had this prolonged period of low interest rates, actually the banking regulations after the great financial crisis, they forced companies into maintaining very high balances of what's called high quality and liquid assets, which is really just treasury bonds, right? So U.S. Treasury bonds, and other government agency bonds. So these are bonds that aren't expected to have any losses with them. So they're that's why they're high quality. But the problem with these bonds is that they have something what's called duration risk, and duration risk is just the interest rate sensitivity of the bond price to moves in interest rates. And it's literally just a mathematical equation. We can get into it later if anyone cares, but basically it's inverse. Your amount of interest rate risk is inverse to the amount of the level of interest rates. So when interest rates are really high, you don't have a lot of interest rate risk. When interest rates are low, you have a high amount of interest rate risk. Well, guess what? We've had near zero interest rates for over 10 years. So these bond portfolios have very low coupons on them, and they're forced. So these bond portfolios are bigger than they would be otherwise because of the regulation. They're bigger than they would be otherwise because of QE, quantitative easing, and the policies of the central bank and the Fed. And they have higher interest rate risk because the central banks have suppressed interest rates to very low levels. So the
irony from Silvergate, from what I read, Seth, too, was like the regulators who assessed the bank's solvency, gave it a thumbs up in effect, but didn't even consider exactly what you're alluding to, is the fact that, oh yeah, they owned safe bonds, government bonds, but gee, these are really long-term bonds. So isn't, as a side note, Ayn Rand always talked about, regulation, the destructive element of regulation. It's like we take as faith that regulators know what they're doing, but they didn't assess a risk that you identified that probably even most first or second year economics students would understand.
Yeah, and that's exactly it. And if you think about the repayment risk or the credit risk in those government bonds, like they're minuscule, even debt ceiling notwithstanding, even still very, very, very small risk. However, what was not contemplated is these massive changes in interest rates. I mean, we've had a 5% swing in interest rates, and that's taken these bonds that are would get paid back at par at 100 cents on the dollar, and in this intermediate period, if they were ever forced to liquidate before they mature, they would lose money. And that is exactly what happened. Now, the banks didn't want to sell these bonds. They weren't afraid that they're going to lose money. But what happened was when you have these customer deposit withdrawals, you have to pay them back with cash. And how are you going to raise cash? Well, you have to liquidate your high quality liquid asset portfolio, because that's the role that it plays here. So these banks basically were forced to crystallize these unrealized losses and blew a complete hole in their balance sheet and sunk them. And that is completely driven by, the regulatory dynamics of our modern day financial system.
Isn't there a possibility, though, that just as in 2008, there was kind of a realization that all these securities that people thought were kind of grade A aren't so grade A? There was a contagion. Isn't there a risk that, what we're seeing is kind of just the tip of the iceberg when it comes to bank failures, that it's not over, that it could continue to spread, not even just here in the States, but globally as well?
Well, I think that's the risk. And, it's hard to, I don't make any predictions there because, it's the old Yogi Berra quote, right? Predictions are really hard, except for, especially about the future. But like, the way how I view it is like, look, you have a now systemic, this is a systemic issue, right? These banks were not the only banks who held high quality liquid assets. If you go back to the article, I detail Silicon Valley Bank's balance sheet, for example, and like 97% of it were in what most people would consider to be, very high quality, assets that, are not at risk of losses. The issue is that, they're not at risk of losses so long as the banks can hold them to maturity. And unfortunately, they weren't able to because of these perhaps idiosyncratic and particular events that led to customer withdrawals. But you have to remember, like, banking is a levered business, right? Banks, the bank business model is, and I know people have a hard time understanding, like even wrapping their head around it today, is like banks borrow your money to invest your money and earn the difference in between. That's what's called a levered carry trade. In other words, the banks, they're not investing their own money, they're investing other people's money. So they run the risk of having to repay people's money when they ask for it. And that's exactly what happened if they don't have the cash on hand. And something very similar happened in the great financial crisis too. It's just, it was done in a different way. So if you go back to the great financial crisis, instead of depositor flight, what you had was collateral flight. So basically you had these lending schemes, right, where banks or financial institutions were borrowing from other financial institutions based upon the value of the bonds that they would post as collateral. And these were AAA rated bonds, made, backed by housing. The rating agencies, which are essentially statutorily, they have a statutorily granted monopoly.
Thank you.
That we can get into after. But the amount of money that banks could borrow against these bonds was dictated by their, by the market values and the ratings. But the ratings were probably the bigger of the two. Well, once we saw these, the true problems in subprime housing, what happened was these bonds would, bonds related to them started losing money. The rating agencies realized they messed up, that actually housing prices could be correlated, and housing, prices could come down, and they could come down in a correlated fashion. It basically turned these AAA bonds into AA bonds. These bonds didn't blow up. Many of these bonds didn't lose any money at all. Just like the U.S. Treasuries, of the failed banks today, they may not lose any money at all, and they probably won't. But the issue is the movement in price of these. What happens is now the banks who were borrowing against these AAA bonds that are now AA bonds, they need to post more collateral, because now the value of their collateral in these lending is basically come down. So they need to post more, and they didn't have it. So essentially the moves by these, call it regulators or quasi-regulators, their actions alone affected every bank in the entire financial system at the same time. And those who were vulnerable to these sort of runs failed. So today, that is the Federal Reserve played that regulatory scheme, right? Because all the U.S. banks subject to the same regulation, they acted more or less in the same way. And now those, who were hit with deposits all failed. In the GFC, you basically had a lot of banks using housing-related AAA securities, borrowing against them when the rating agencies all downgraded because they're all the same. Essentially, when they downgraded, they had to post more collateral. Those who didn't have it failed then too. So there's very similar undercurrents to both today and the 2008. We'll just leave it at that right there. Yeah.
Well, Marilyn, thanks for your contribution. She says it's pretty scary for a retired layperson. And ironically, Seth, it's many retired people who've seen their portfolios decimated in just the last couple of years. They bought bonds, which they thought to be very safe. And, those bond portfolios, just like the banks, have been down, 10, 15, 20%. Last year, people got annihilated just owning, safe government bonds. Is this another example of, I guess what is known as malinvestments, that when government gets involved in the marketplace, they create incentives to basically buy real estate that is not worth it, or to invest in bonds at uneconomic levels and uneconomic ways?
It's funny. I'm glad you brought this up because I totally dropped the ball and forgot to, kind of put a little disclaimer out before I say anything here. It's like, these are just my personal opinions, and this is definitely not investment advice. They don't reflect the views of my employer or anyone that I'm associated with. So take all this, as my independent kind of analysis. Do your own work before you invest in anything like that. So again, this is not me giving you investment advice.
But seriously, what should I buy?
Yeah, you're on your own for that. Yeah. But yeah, listen, I mean, I think part of it too is like, just because there's similarities and differences doesn't, or similarities 2008 doesn't mean the market is going to behave like 2008. So like, one thing I've learned over my investing career is I've moved away from trying to predict markets and, like our market's going to go up or down, our market's going to go down. And I moved, more towards what's the risk of markets going up and what are the risk of markets going down. And what I think today has highlighted is a fragility of the markets that people knew about. We all talked about, what low interest rates would do and the malinvestment of capital and things like that. The duration risk, right? The interest rate risk that was shepherded, basically concentrated in bank portfolios, has just come to light in this move in interest rates. And now the question is, an investor, what's your risk tolerance? What are you going to do about that? And that's sort of how I'm thinking about my portfolio personally. I wrote an article early in this year. It's called like waiting for the Fed to pivot, something like that. And like that kind of, in that article there, I kind of talk about why I'm sort of, this is before, the bank failures, kind of like why I'm just kind of waiting this out, and, the volatility, of interest rates and how that affects markets. So I encourage you to kind of look for that. But, this is something that at least me as an investor, like this risk is now obvious, and how, and I'm trying to assess how I'm going to be, act now that I know it's here. I mean, I knew, I suspected it was coming, and now it's like, what am I going to do now that it's surfaced? And, you see people taking different sides. There are people who are saying these are purely one-off events. My, take is this is highlighting a systemic fragility in the financial markets. And now, once you know what it is, now you can figure out how to better position your portfolio to kind of meet your, objectives and, risk tolerances.
Marilyn, thank you again. She says, that's what scares me, all of the government involvement in everything. And she totally understands this is not financial advice. Rand often wrote about, gold. I won't even try to begin to quote her, but and again, this isn't investment advice either, but, you take a look at these true long-term stores of value and how an ounce of gold in one safety deposit box literally remains untouched, unblemished, for decades, for centuries, left on there. And given the fact we've seen it, you said a Credit Suisse. I mean, this was, I believe, one of the top 4 or 5 banks in the world, certainly one of the top 10, simply evaporate in just the last couple of months. Anyone who's followed the financial markets over a period of time has to kind of be a little stunned to see that type of wealth evaporate.
Yeah, I mean, I would say, look, I mean, MA, like, don't think of it as these are scary. I mean, think of it as like now you know, right? And you know something, and now you can act about, a risk that is now to me, pretty obvious, right? You know, just knowing that there's systemic risk or, allows you to act in a more integrated fashion. So, what you want to do with your portfolio, again, it's not something I would necessarily, discuss or even could even tell you what to do without kind of knowing, your investment objectives. But, like you don't, this is not something that you necessarily have to be scared of. Now you have knowledge and now you could act accordingly. What you want to do with that is sort of the next step. So, knowledge is power, not to be cheesy, but.
No, it's so true. And, even just thinking way back when, and during that period of time when, I tweeted out a chart just this over the last year, short-term interest rates have risen from something like 0.7% to 5.7%. So we've seen this tremendous backup, and and of course, government, to Mary Lean's point, is at the center of that. So Seth keeps an eye on all of this over here at the Integrating Investor. Here's the article once again. We definitely recommend checking that out. And Seth, in just a couple of seconds we have left, the minute we have left, tell us a bit about what's on your screen now, not just from a blogging perspective, but in terms of how you integrate Miss Rand's philosophy into your own perspective on markets and perspective on the world.
Sure. Yeah. So anyone who's sort of read, have visited the site, has probably picked up, the whole reason why I started the website was, I've been a professional investor for almost 20 years now, at a variety of shops. And I started writing because I saw contradictions between kind of mainstream ideas and what I would kind of see, on my screen. So that's what got me writing. And one of the big themes of my writing has been definitions and really cleaning up a lot of the financial concepts that I hold in my mind. So one of them is like, it's gone all the way back down to what is the definition of money. And once I sort of clean that up, markets make a little bit more sense to me these days. So, what I'm looking at, and actually this is in that article, from the beginning of the year, why I'm waiting for the Fed to pivot is, volatility is bad for financial markets. And it's bad for financial markets because financial markets are leveraged. There's a lot of leverage in the markets. So volatility is just bad for that, just in short speech. So I'm waiting for volatility to kind of die down. The Fed is at the heart of this volatility. And why is the Fed at the heart of the volatility? Well, I actually don't believe the Fed has any of the powers, to the at least to the degree that many in the market seem to attribute to it. Like the Fed is not allocating massive amount of capital, across industries. I mean, the whole reason why 2008, happened, that crisis, was you saw a vulnerability in the shadow banking system. Like all of that, 2008 happened outside of the Fed's purview, completely. So that just shows you there's a whole big world of financial system out there that has nothing to do with central banks. And, thank goodness for those, because that's how.
You don't think any of the ultra low interest rates after?
This is where I was going with that. Yeah. It's like, so, where the Fed does have an impact is on the movement of kind of interest rates. Now, interest rates move around and for all sorts of reasons. But, the central banks do impact, obviously, short end government bonds, and those filter through to the rest of the economy. So what the Fed is doing is they're moving these certain rates around super dramatically and all at the same time. Right? If you look at like a free market, if you pull up any of the other sort of bond markets, take like the corporate credit market, like bond yields are correlated, and they kind of move in the same direction at the same time, but not always so. And that's because you have many different actors kind of buying and selling all sorts of different bonds, all for all sorts of different reasons. But when you have central banks, they're moving this one interest rate around at their own discretion, and it impacts everyone. So you have this centralization, this concentration of risk, and that's what, to me, one of the real dangers is of central banking.
They always say, is the Fed making the right move? And to say there's no how they can't make the right move. And Bonnie Bertrand, who is a YouTube member, Thank you, Bonnie, for being a YouTube member. She says, government is the force of law. We forget that. And all the government involvement and everything totally scares me. It's not going away. It's constantly growing. The worst is that now it's taken for granted. Kroger gives 5% discount to food stamp users. So, maybe that's a kind of a good ellipse here, Seth, and the way out is that, of course, they're going to say free market and banks' greed is what caused this latest crisis. But banking is about the least free part of the economy. Financial services is about as regulated as it gets.
Correct. Yeah. I mean, there was nothing about free markets that caused today or 2008, right? They were both caused by kind of these, quasi, by these regulatory forces. Today was caused by banking regulations. Let's not forget the role that banking regulations have on what assets banks put on their balance sheet. Huge. This is a huge influence on them. Let's not forget the influence of QE, which quantitative easing, which was literally the Fed gave banks excess money, like they had no choice, and banks are like, what am I going to do with this? And coupled with the regulatory environment, it kind of coerced them into or incentivize them to sort of buy these treasury bonds. And then the Fed,
deposit insurance, the monopolization of the rating agencies, which still exists. Every element of it is highly regulated.
Absolutely. So, I mean, so these banks today we're basically forced to have this, we're however you want to say, nudge to own like a lot of interest rate risk. And then the Fed raise the interest rate risk. They basically exposed all that. So it's not a surprise that we're seeing a lot of banks fail. 2008, again, it was the, rating agency dependent, you can't just start a rating agency. So there was all this, and again, other sort of bank capital laws and regulations all force these banks to do the same thing. And you have one change by basically these entities, just like you have one change by the central banks, these singular entities, and it affects the entire industry. So it's basically just, regulatory is the regulatory environment is concentrating risks, and when they move, it impacts everyone. And that's when, that's when problems happen. You don't have, a multitude of actors acting on their own, rational self-interest.
And that's, I think that's the frustrating altruism that always comes back is, when something blows up, they blame the 10% of the marketplace, which is capitalist, and ignore the 90%, which is statist, highly regulatory, controlling, and of course the altruism is we have to do something, leads us in more than thank you for explaining this for the audience today, Seth, for us, and being a part of what we do here.
Sure. Yeah. I hope that helped. It's pretty complicated, and like even a lot of professionals don't understand it. So don't beat yourself up about it. Anyone listening out there, I would say I have a pretty good understanding, but I may be wrong about this too. That's how complicated a lot of these systems are. If anyone has any questions or want to reach out to me, you could hit me up on, my spots up there. I try to respond to people. I try and be responsive, and if you put a comment here, I'll probably respond to that too. So always happy to connect with folks.
And and objectivism is about living. It's about life on Earth and succeeding on Earth. And Seth is so masterfully integrates his passion in investing with his passion in objectivism in a really fulfilling and fun way as a reader, no matter what level of expertise you're at. So he lives it and he shares it with us at the Integrating Investor. So thank you again, Seth.
Yeah, well, thanks for the kind words, and my pleasure.
Right. And thank you for being part of what we're doing here Monday through Friday. It's all about the Daily Objective and the Ayn Rand Center UK. As we've said over and over again, history's biggest daily network of original material inspired by objectivism. And it's brought to you by people who know a little bit about objectivism, people like James Valiant, Dr. Peikoff. We've had many experts. Harry Binswanger has a regular program right here on this network. He, of course, worked with Miss Rand, knew Miss Rand. So we're all students of objectivism. And that's the fun part, is learning about this philosophy, applying it to your life, thinking about it, getting energized about these ideas, and networking with like-minded folks all over the globe. So we'll be back here next week with more original programming. And as we always say, hit us up on the YouTube and the UChat and make us part of your daily media ritual. So for Seth, Levine, it's Jonathan Hoenig, and all of us here at the Daily Objective. Thank you. Have a peaceful weekend. We'll wish you best premises. Be
And
well.
happy summer.